A growing wall of worry is building for investors amid escalating tensions in the Middle East, an ongoing port strike that could cost the economy potentially billions of dollars. Joining us now on how to position yourself is Talley Léger. He is the chief market strategist at the Wealth Consulting Group, which oversees more than $4 billion in assets under management. Talley, it's great to have you here.
Great to be here.
On set. So let's talk about that wall of worry. There's a lot of uncertainty. We certainly have seen the escalating tensions in the Middle East. Is that really weighing on the broader market this week? I'm just curious, just your assessment of how big of a risk you see this posing to the market's momentum.
Sure. Well, I think worrying about the risks is probably one of our favorite pastimes as investors. And I think to your point, we've been barraged by some pretty major risks in the headlines just in the past week. I mean, we've been talking about missile strikes, port strikes, hurricanes, elections. And I understand, people might think that this is the most challenging or uncertain of times, but when are they perfectly certain? Mm-hmm. Just imagine being born in 1900 and growing up to witness 2 world wars, a global depression, the assassination of one president.
Spanish flu.
Exactly. And yet, through it all, the stock market has continued its inexorable march forward. So I think you buy the dips here.
And so where are the largest dip buying opportunities right now with volatility spiking the way it is?
Yeah. So we have been, as a firm, kind of taking profits, harvesting gains from some of the big winners like technology, which has done so very well, and reallocating some of that capital into, until very recently, the lagging areas of the market. I like the domestic value cyclicals, like financials, for example, which have been benefiting from these Fed rate cuts, steeper yield curve that's supportive of bank net interest margins, and we've also seen a broad easing in financial conditions. But I also like some of these global cyclicals, including industrials and materials, because of the same global monetary support that we've been seeing, a firming in raw industrial commodity prices, including metals, iron, and of course that's pricing power for some of these companies.
Is it China specifically that you're looking at? We've just been talking about so much, obviously. Do you look at the gains that we've seen over the last several days on the heels of this stimulus? But when you mention international opportunities, I guess more specifically, where are you finding that?
Yeah, I think China is a big part of it. They've pulled a lot of levers. As I say, it's really a global monetary backdrop that we're painting here. And the Fed as well is a big part of it too. And I think the way you play that domestically is some of these global cyclicals right here at home, including the industrials and the materials stocks.
What's your outlook as you think about this earnings season that's set to commence next week? We're going to hear from some banks that typically set the tone, give us their kind of meteorological economic forecast for what we should expect in Q4, what they're seeing in the consumer environment. How does the perhaps common denominator make itself known among earnings companies reporting earnings, especially coming off of an extended and pronounced period of everybody just saying AI and just putting the AI button out there?
Right. Well, I'm generally a pretty bullish guy. And what I'm seeing, just looking across the investment landscape, we've got 2% economy or better. Mm-hmm. We've got 2% rate of inflation or slightly less. To your point, earnings, I think, have bottomed for the cycle, and they're actually kicking into a higher gear, and now the Fed's got our backs and is cutting rates. I think it's a pretty interesting environment to be fully invested and participating in this market.
And we talk about earnings being a real catalyst here for the markets going forward. What about the econ data? Because there's lots of questions and maybe some hesitation about what we could see from jobs out tomorrow. Are you confident that the market can continue this rally despite the prints that we're going to get on jobs?
Look, I think as a long-term investor, I'm always waiting for some kind of a pullback because I think it pays to be an optimist. But one of my key indicators right here is the Fed's weekly economic index, because it really gives us a real-time sense of activity across a few major sectors of the economy. It's got stuff in there like rail traffic, steel production, fuel sales, claims, staffing, you name it. It's got everything, retail sales. And some people are pointing to a slowdown. What slowdown? That measure is actually reaccelerating. So again, I think it supports the notion that we're in a mid-expansion pause.
Talley Léger, who is the Chief Market Strategist at the Wealth Consulting Group. Thank you so much for taking the time here with us.
Cheers.